The dot-com bubble. To understand why this critical piece of history literally shaped how we operate and communicate till today, we first need to understand how this all started. And the story begins with two American software engineers, Jim Clark and Mark Andreessen. It's the 1990s and the internet is starting to explode in the United States. And Jim and Mark, well, they sensed an opportunity. They meet up at a cafe to discuss how they're going to capitalize on this new booming technology. They start exploring ideas, interesting business strategies and concepts around things like online gaming networks and much more. They even tried out some of these ideas, but most of them didn't get traction. That's until they started thinking about a new idea, which was a user-friendly and free internet browser, and that was Netscape Navigator. So they explored the idea, they tested it out, and then they put it to market. And then it was an instant success. Just 16 months after the start of the business, the company would make its initial public offering. This moment right here, when Netscape Navigator goes public, that's where it all begins. Netscape's IPO would be the catalyst behind the dot-com bubble. The company saw its stock price shoot up to $75 after an initial offering of just $28, and this happens on the very first day of trading. It was an instant success, and let's just say that it didn't go unnoticed. Investors and venture capitalists, or VCs, started to take a big interest in this new technology, in this new industry. The immense success of Netscape's IPO would trigger an investment frenzy. It got to a point where any startup promising big results with this new technology would get an investment right away. All of this started to set the tone for the internet age. It was so enticing that even the most experienced, risk-averse, and traditional investment firms were getting pulled into this mania for the fear of missing out on this lucrative opportunity. At its peak, it was possible for a company to raise millions of dollars of investment even if it lacked a finished product, as long as its operations were somehow related to the web. VCs were trying to find the next big thing, and they invested in any company as long as it had a .com after its name. This kind of speculative behavior by investors started to create a massive bubble. And as history teaches us, the formation of bubbles usually go unnoticed. So you're probably asking, what would create an environment that would enable speculative investments like this in the first place? By the way, are you subscribed to the channel? If not, please do hit that subscribe button. It really helps me out a lot. Okay, so let's get back to it. Why did people start investing like crazy even in the first place? You see, in the 1990s, it was an amazing time to live in the US. The economy was booming, interest rates were low, inflation was also low, and many people saw an increase in their discretionary income. But the most important factor at this time was the Taxpayer Relief Act of 1997. This act lowered the capital gains tax for investors, and it encouraged people to make more and more speculative investments at the time. It's also important to note that the financial situation in other parts of the world, especially in the bigger Asian markets, were worsening. So the US dollars were being pulled out from foreign markets. So basically there was a lot of money in the US market that had to be invested somewhere. And jumping on the bandwagon, people started investing more and more in tech companies. You see, the options at that time was to either go with traditional companies with relatively slow growth or in the tech sector, promising double-digit returns. It was a no-brainer. Putting things into perspective, it's easy to understand why everyone was getting so caught up in the dot-com frenzy. The more this happened, the more there was money available for these tech giants, and the bigger and bigger the bubble was getting. Despite all of this investment, most of the dot-com companies themselves weren't really making a profit. They were operating at net losses, and in fact, they weren't even based on a solid foundation to begin with. Most companies were spending heavily on advertising and brand awareness. For promotional purposes, they were also giving away their products and services for free or at huge discounts. The mentality of the entire industry was growth over profits. The idea was that as long as they could justify to their investors that the money was being spent on growth, it was all good. This meant that they could spend irresponsibly on unnecessary luxuries like employee vacations, dot-com parties, lavish offices, and so on. There was very little fiscal discipline, and as you can imagine, the bubble just got bigger and bigger. By the early 2000s, it was apparent that the economy was running out of steam. As a result, investments and cash flow to tech companies began to dry up. Several big-name tech companies began to sell their stocks to generate their revenues. And seeing this, the smaller investors also started to panic and they started selling their own shares. Around this time, the US Federal Reserve also announced a small increase in interest rates to help tackle some of the inflationary pressures. This meant that there was a reduction in investment capital, and investors in dot-com companies started to panic even more and more stocks were being sold off as a result. The cumulative effect of all of this ensured that the stock prices were plummeting even more, and the trend was only worsened with the news that Japan was again in a recession. You see, Japan was the biggest IT market next to the US, so when they started to face trouble, technology companies from all over the place were starting to get impacted. From its peak, in a matter of months, the Nasdaq Composite Index fell by some 5,000 points. Effectively, trillions of dollars of invested capital were wiped off. Several big-name companies started to fail. They ceased to exist. Around this time, there were also many paper millionaires, people who invested in tech companies, and in theory they were millionaires, but they never pulled out their money. They never realized their gains. And after the bubble burst, the millionaires who couldn't cash out in time saw their entire net worth evaporate. And even if there was the slimmest chance of a rebound, that hope got crushed with the tragedy of 9/11. Which happened a few years later. It seemed like the glory days of the tech companies was over, but it was not all bad news. Don't get me wrong, the investors and the smaller scale investors were hurt pretty bad. However, from a historical perspective, the dot-com bubble actually had a lot of benefits. You see, large amounts of investments boosted R&D into the tech sector. It allowed for heavy experimentation and an openness to novel and new ideas, which may have never been realized in a more conservative investment environment. You see, the idea of a small player with little experience but a big vision and a big dream actually succeeding became more mainstream. Investments behind these endeavors were now being more regulated, and there was a lot more due diligence. So for these players to succeed, it was more about demonstrating effectiveness as opposed to showing novelty. You see, the dot-com bubble made this shift possible. At the end of the day, what the market got from the dot-com bubble was perspective and a reality check that not all things that are flash and no substance are going to work in the real world. The message was very clear. There's always room for innovation, but not so much for BS. There are a few other benefits from the dot-com bubble as well. For example, it's the reason why high-speed internet became cheap at the time. You see, the dot-com bubble created immense growth in the telecom sector, and that led to the expansion of internet infrastructure. So when the bubble burst, the telecom companies found themselves operating at a great overcapacity since their business clients were gone all of a sudden. They were forced to create cheaper services aimed at mass consumers, and that's how they survived. And that idea kept on going till today. You see, the dot-com bubble is a cautionary tale about getting too excited about businesses with lofty promises but shaky fundamentals. Too much of it, and it leads to a bubble, and that's bad for everybody. So the question is, are we starting to see something similar with newer technologies like crypto, NFTs, and AI? Time will tell. But what we can take away from all of this is that jumping on a trend can sometimes be too good to be true. Fear of missing out is very real, but what's more important than missing out is being smart and doing your due diligence. It's not always sexy, but it's the right thing to do. Speaking of bubbles, did you know that there was another bubble a few centuries ago about tulips? I made a video about the Dutch tulip mania right over here, so check it out, subscribe if you haven't already, and I'll catch you next week.